Well, hello, PTAers. It's our total pleasure to be presenting some findings to all of you now. Eric and Chris and the admins asked Lisa Parker and myself if we would share our thoughts, and we didn't want to do something just off the cuff for you. We wanted to back it up with some graphs and charts. And just so that you know who we are, if we haven't met you, Lisa and I are both Melbourne-based buyers agents, and we cover a little bit beyond Melbourne, but we're Victorian BAs, and we've proudly been part of this group for quite a long time now. So it is an absolute privilege, and we hope that you find some of this helpful. Now, Lisa and I are going to kick this off by letting you all know that we're recording pre-election, and we will be coming back to you in about 6 weeks' time to give you a new snapshot and talk about whether there have been any changes in the market that we should all be mindful of. But without further ado, we're going to share with you our findings from our coal faces now. Lisa, over to you.
Well, I think a good place to start is perhaps catching people up with where we've been and how the property market's been tracking up to about, I would say, December of last year, because we were in incredibly tight conditions with a lot of buyer activity. And what felt to me, even though statistically the listings were increasing at the time, it felt to me that we had very limited stock available on the market. So it were very tough conditions, and we were seeing prices escalating and running away. However, coming back into the year, starting at 2022, the conditions have changed a little bit. That has certainly been my experience, and I think the statistics are showing that as well. Cate, did you want to talk a little bit about statistically where we're at? And I'll just show this graph for our viewers whilst you talk about the last 6 months.
Yeah, absolutely. I love my charts. We've, in Melbourne in particular, we've really been flatlining. It can only be described as a static market. And since the heaviness and the craziness of 2021, we really calmed down at the end of November. And so since then, we've had 6 months of pretty much 0% change. It's hovered between 0.1 positive, 0.1 negative. And what we have experienced is it's not necessarily a two-speed market, but a varied market. And some of our capital cities are still flying, but the two big ones have certainly come off. Now, I want to draw your attention to the combined regions, because this is a fascinating story. And for the first time in a long time, our combined regions have outperformed our capitals, and for good reason. The thing is, a lot of people have speculated whether regions have gone off and it's temporary due to COVID, or whether it's been exacerbated by COVID and we've got some changes here to stay, or whether COVID isn't everything to do with it. And we've got some thoughts that we'll be sharing with you today on that. But when we have a look at this chart here, you can see that there are markets within markets, and not every market is performing at the same rate. But I think if we circle our own home city, I'm quite surprised that we've been able to sustain the growth that we did based on how severe things were, particularly with extended lockdowns here. And as you've read in the news, we've had a bit of an exodus to other cities and regions. So I think Melbourne's an amazing story in spite of what it's been through. Would you agree, Lisa?
Look, it was very, very surprising. I mean, we've spoken about the fact that we, at the start of COVID lockdowns, we had all of our clients going on hold, with the exception of maybe a handful. And those few clients that did go on hold at that time came back to an escalating market that was probably one of the busiest markets I've operated in for quite some time. And I mean, we had days where we'd receive text messages in the morning for 3 or 4 different properties we had interest in, saying the auction's happening today at 12 or at 6 p.m. tonight, and had been brought forward. It was originally scheduled for 3 or 4 weeks down the track, and then suddenly we had an auction on that day. So we were prepping and doing due diligence for 4 properties in one day, and it was a mad scramble because our due diligence process, as I know yours is as well, Cate, is quite lengthy, and we had 3 of us smashing through due diligence just to prepare. And that's changed now. We're in a much nicer, more balanced market, and I think the statistics reflect that. When we look at this chart, we can see that overall we've had some growth in the Melbourne market of 8.4%, and for the last quarter we have had basically 0 growth in our markets, and I'm certainly seeing that on the ground. And I think we'll talk about some vendor discounting later in our presentation, Cate, but I certainly agree in this instance that the statistics and what I'm experiencing on the ground are quite the same.
It makes comparable sales a bit easier, doesn't it?
It sure does.
You know, last year we were just overlaying all of these growth rates. Oh, that's 3 months old. It's grown heaps since then. What a crazy world we're in.
Well, I'm sure you had to do the same thing, Cate. We had to actually go back beyond the 3-month period and kind of look at other periods where the property market was comparative to what we were experiencing, and we had to, you know, calculate quite differently to how we normally do. So yes, it was add 10% and then add 10% more in some instances. So I guess the thing that's on everybody's lips, that people have got questions, which we're going to touch on, but we're going to provide some data before we do that. We know that many people are thinking, if you're a buyer, should you wait until the property prices come down? Will the property market crash? Will interest rates go up? And if you're a seller, should you sell now? Or even if you're not planning on selling, but you do hold real estate in the Melbourne market, I know that some people are wondering whether or not they should get out now. And we are going to circle back and touch on each of these things. But first, we want to present the data and some key market indicators, and then we'll wrap it up with our thoughts on each of those questions. So Cate, where should we go from here? We've got quite a bit to cover.
Yes, I do want to tap into how you're addressing this question, because as buyers agents, I know plenty of us are fielding these questions. And I put together a graph that showed the relationship between interest rate, cash rate movement and property prices historically, because I love relying on historical data. And I think it would be valuable to hear how you're talking through when people ask you the question, should I wait and maybe chance getting a bargain in 6 months, or should I remember what happened in 2020 when people said that the market was going to deteriorate? What sort of answer and what sort of information do you give people to think about when you get that question?
Well, Cate, while I answer that, do you want to see if you can grab that graph? I've got the screen share on, so you should be able to screen share whenever you're ready, because I know that you've got that graph on your website.
Yes.
So that would be, I think, a really interesting thing to show people, because I think there's a natural assumption that people make that when interest rates go up, the property market crashes. And certainly interest rates are a lever when it does come to property growth. However, there are so many other levers. And this was made more apparent to me, and really, this has really stuck with me. There was a lot of things that were going on in our industry. I think it was about 4 or 5 years ago, we had the rental reform on the horizon. We had the potential for capital gains tax changes. We had potential for the removal of negative gearing. There were all these things that were happening in the property market, and a lot of us professionals were quite concerned about how the market would respond. And so we got together as an industry, and we had a politician come and speak to us, and we were asking them questions, and he was like, oh no, we're not worried, we've got so many levers we can switch on or off at the drop of a hat that will make the property market do what we want it to do, that we're really not worried at all. That changed everything for me. Hearing that from a politician, that they have levers that they can just press on and off, just it was one of those moments where everything changed for me. And it made me realize that there's not a lot that we can actually control, and the government can literally change policy. There's so many things that can change with property that either switches the property market on or off, that there's never really a reason to wait or delay purchasing if your personal circumstance dictate that it is time to actually purchase. I think there are very small windows of opportunity where people can get a bargain and do extremely well. However, those moments are fleeting. And I think for the vast majority of people, we tend to take a long time to think about things, and we tend to want to wait and see how things are tracking before we make decisions. And unfortunately, the property market does change so quickly that we often miss those opportunities. There's very, very few people who will go against the grain. So I like to talk about the fact that as humans, we are, unfortunately, we do tend to move in groups, and we have a group consciousness and a group think. And at the same time, we're all kind of thinking and feeling the same things. And it has to do with obviously what's happening around the world, but also what we're consuming through the media and the conversations that we're having around us. We become our own echo chamber, and we become, you know, a group of thinkers that are all thinking the same thing. So we all move in the same direction. So when we're fearful that property prices will drop, a lot of people will change their decision making, and sometimes we can actually cause the property drop just because of our own belief system and the actions that we're taking as a result of that belief system. Other times, for some reason, it goes completely the opposite way, but it takes a long time for these people to see that. And by the time they've seen the evidence that the property market is actually strong, they haven't acted, and they've actually missed the boat, and they've missed the upward swing. And we see this all the time, people trying to time markets. It never works, Cate. There is very, very, very small windows of opportunity. And we can never prepare somebody for those windows of opportunity, because sometimes it is as simple as we've had 2 or 3 weeks on the ground where buyer numbers are really low and auction clearance rates are low, and there's no rhyme or reason for it. And we're able to pick up properties for 5 or 10% less than we would have in a busier week. But it can literally just come down to a strange 2 or 3 week period where something's in the air and people are just not making decisions. So for me, so for me personally, I think that people who are wanting to buy should move forward and prepare themselves with their finance, engage their buyer's advocate and get their strategy ready. And if you're not using a buyer's advocate, at least have your strategy ready, be purchasing ready, and be actively in the market, ready to make a move on the right opportunity. Because right opportunities, they do come up often, but A-grade properties don't, particularly in this market. And I think you need to be on the ground actively looking to assess whether or not it's time to move forward or not. And I think the opportunities are so fleeting that you must take them. If you wait, I think by the time you jump in, everything that you're concerned about has already happened or hasn't happened, and we've moved on to a different set of circumstances for us to worry about.
So perfectly said. I couldn't agree more. And you've talked about herd mentality. You've talked about social proof. You've even talked about the influence that sentiment has on our market. Sentiment counts for so much, and sentiment can be a reaction to something, sometimes a worthy thing. Other times it's not necessarily a worthy thing. It can be media hype. And we have to be really careful to understand, first and foremost, how powerful sentiment is and how quickly it can change. And when it does strike and people get rattled, history has told us in recent decades that period of a declining market or a very nervous market is not usually a very long tenure. And if we think about even downturns, and I'll talk about these in our charts, aside from 2011, 2012, we haven't had property downturns in the last 20 years that have spanned longer than that. Most of them have been within the 12 to 15 months, and some of them have been really short. And to your point, if we cast our mind back to March 2020, when the pandemic was declared, I remember things deteriorating really, really quick. And I started charting resultant prices achieved for properties that I had assessed before the pandemic was a threat. And we saw price declines around the 10%. And interestingly, it was very short-lived. I had, like you, I had a lot of clients wanting to go on pause and they were nervous. The ones that stuck with it and said, no, this might be my opportunity, because if we think back, particularly for the Melbourne market, we were having a really aggressive run until that happened. We were in recovery from our credit crisis and our downturn in 19. So all of a sudden, almost a year later, we've got a different crisis, and people are always nervous about stuff that they can't predict and don't understand. And that leads me to the election now. We're sitting here with an election looming, and a lot of people have recognised that it's not necessarily a big threat. In fact, we have no tax reform, we have no housing policy changes that are likely to impact the property market for investors and homeowners who are out there shopping now. And we're still saying, oh, let's wait and see. And that's because we've got a finite date. It feels like a short period of time. And you know, for that ability to feel like you're making a safe decision by doing nothing, people opt to do that. But if we go back to COVID and think about how that impacted people, we had headlines saying that we'd have colossal price falls. We had bank economists even going on the record saying that we'd have colossal price falls. And a lot of people sat back and decided to wait, and some were just terrified, and others were feeling like they were being opportunistic and waiting for a market crash so that they could buy with the same currency and get a better product. And we know what happened there. And it literally was 3 weeks of buying opportunity, and then it just took off. It was crazy.
And it came back not just the 10%, but it came back the 10% that had dropped, plus another 10%, and then another 10%.
You're right.
On. So, Cate, can you walk us through this graph? Because I think it's a great illustration of what we're talking about here, and just talk us through these green circles and what each of these things on the graph mean.
Okay, a lot of people are wondering whether interest rate rises equate to property price falls. So I thought I would circle all of the property price falls we've had in the last 20 years. So if you look on the left-hand axis, the blue line here is national home values in terms of their monthly movement. So if we have 1% growth in 1 month, then you can anticipate for that particular month it will hit 1 above the horizon of 0. And where I've circled, they're the negative price falls, and they're the declines that we all remember. So those of us that were active during the GFC, that was a very steep decline. That's the second circle. You can see there that we did have increasing cash rate, which is the orange line, and that has the axis on the right-hand side. The cash rate got reasonably high, and mortgage holders were feeling that, you know, every couple of months, every month, it felt we'd be getting a letter in the mail saying 0.25% increase. And none of us liked it, but we didn't have mass hysteria over it either. And when we had our correction, a lot was going on. It wasn't about cash rate increases. That was the GFC. It was an enormous global event, and that created a lot of hysteria. And then the cash rate plummeted. And for those who recall, Kevin 07 had a plan to really shake up the property market and try and instill some confidence and get buyers buying. And we had first home buyer grants, we had building grants, we had a lot going on. And I was a mortgage broker at the time. I think you might have been, or you're a buyer's agent, Lisa.
I was doing both at the time, Cate. Yes, but my mortgage broking career was very short-lived. I hated it. It was great. It was great to understand how the lenders work and all the rest of it, but the actual paperwork side of it, not my thing.
Yeah, hats off to brokers. You put up the lots with banks. I recall 5% as a variable interest rate being a figure that we hit, and that was a record low. And I could not believe that we had an interest rate on offer to consumers for 5%. It was so low. Anyway, that was the GFC. So we can't use that as a data point. Then we look at 2010 or beyond, 2011, 2012, and I mentioned that we had a longer period of downturn then, but the losses weren't so dramatic. So our price falls were not as great as they were in 19, for example. Now there you can see that we did have some cash rate increases, but it was reasonably modest, and it was quite static at the time that the market was in decline. So that again is not a data point that I think correlates what was being claimed by some. And then when we look at what happened there in 2016, we had a little bit of a wobble. We did go into negative territory and the cash rate was falling. So how do we explain that? And again, for the next 2 downturns, we had a falling cash rate. Obviously for COVID, we had some crisis measures that were introduced by the RBA, because we had to use what we had to stimulate the market, and I'd argue that they overstimulated it. You can see what happened then. But my point is, when we've had periods of decline, they haven't been caused by increasing cash rates. And the next chart, just to illustrate my point, takes us back to 86, and the first interest rate increase. This graph's a little different because the blue line shows median house prices, not house price movements. But the interest rate increased, and it hit 17%. And our parents will all tell us how horrible it was. We most of us weren't active in the property market at that point. I was a teenager, and it was awful. But that was when we floated the dollar, and Paul Keating's famous words, we had the recession that we had to have. But let's have a look at what happened to property price movement there. We didn't have a plunging market. It did nothing for quite a while, but it certainly didn't plunge. And then the second cash rate increase, I would argue, was relatively sharp, and prices were still moving upwards. Then the third one, same again. The area that I've highlighted in that yellow box shows that we've got house price increase and interest rate increase pretty much in step with each other. So there's no relationship there to demonstrate that house prices are crashing. And then the final one, of course, shows the same thing again. So I'd like to think that I've disproved that idea that a cash rate increase will tank the property market or create a housing price downturn.
I think the other thing that these, just looking at these charts, Cate, it's bringing back memories of the different times in my career that I've worked through. And I remember the GFC quite clearly. And the thing that I remember most about it, and I think it's important to note, correct me if I'm wrong here, that was the only time over the last 20 years that we've had a downturn that has lasted 2 years. Is that correct? And every other time it's been a 12-month run?
Actually, the GFC downturn in the Australian property market didn't last very long. It was the 11 and 12 that lasted for 2 years. It was a bit of a hangover, and that was the Eurozone crisis, which again was linked to the GFC. But our price movement during the GFC, median house price, was very, very aggressive in terms of an uptick because we stimulated things. And you talked about levers that governments can pull. We absolutely pulled some levers, and we saw an enormous run. And we had a two-speed market at that time as well, because we'd incentivized first home buyers to flood the market.
Yeah. And so I remember the one that did go for 2 years. I remember it was a very, very gradual, like slow, lovely, soft landing. And then it hit its bottom, and then it took 12 months to very slowly get back up to where it was. And then when it got back up to where it was, it went again, and it was very gentle. So this was estimated to be the massive crash. I remember people were talking about 40% crashes, and it just didn't happen. The decline was so soft and gentle. However, I remember the sentiment of buyers at the time being petrified to purchase property, and the few things that happen. And the reason why I want to point these out is because I want the listeners to remember these few things, because they're going to experience them if they're thinking about buying property. These are the thoughts that are going to be in their head, and if they take the chance and step forward to actually buy a property, then they're going to have these things go through their mind. I really want them to remember. So at auction, when properties passed in at auction, the social proof had disappeared, and people who were really keen on good quality A-grade property all of a sudden thought, oh my gosh, what's wrong with this property? Maybe I shouldn't buy it, when they were the underbidders and we were negotiating after auction. And so that was one thing. They started to doubt the stock levels and they started to doubt the quality of the property, because there was no social proof telling them that that was a good property, because things were failing at auction. The second thing that would happen is that when we were talking to clients about pricing, we and often the vendors had already adjusted for the downturn price, but buyers were wanting to knock another 10, 15 or 20% off the price. And so when this happened, there was a massive gap. It's reasonable for a buyer to knock 10 or 15% off if the vendors are asking a correction price. But if they've already accounted for the correction, there's no discount I really want buyers to remember that and to make sure that they do their comparable sales and to know the value, the true value of property, because people missed out on really good quality property because this stuff happened in their brain that they didn't know how to stop or counteract. So those two things I really want people to remember. The other thing that happened for people psychologically is, well, what if the property market continues to drop and I'm actually buying up here and it's going to drop further? The thing is, that's what property prices do. They go up and sometimes they come down. And I've personally purchased properties. I've purchased 3 properties in my lifetime that I literally purchased at the peak. They went up and then they dropped 10%, and then they continued to go up again after that. Property prices will always go up and they'll always come down. I didn't sell those properties when the property market came down. I wasn't thinking, what if it comes down more? I owned the asset, it's long-term, I was holding it long-term. The only thing that mattered was that I could hold the property and continue to hold the property. Property is not something that we should transact in and out of quickly unless we're a developer, or unless we're flipping property. Because the in and out costs are just too expensive. It costs us too much money to buy and sell property. That's when people will lose money, if they trade out of property sooner than they're expecting. And I've actually seen quite a few of my clients actually starting to trade out of their properties that I bought them 3 or 4 years ago, because they're thinking, oh no, well, it's really performed well, it's done what we wanted it to do, so we're extracting our money. But then they're hit with capital gains tax and they lose half the money that they thought that they'd made. They actually haven't made as much as they could have. And there's zero reason for them to sell the property. They're just thinking, oh, well, now's a good time to sell. Property prices are performing well, I'll just cash in and collect the money. Well, now what? Now you need to buy back into the market and you've got to pay stamp duty. You know, do not sell property just for the sake of selling property. If you've bought it to hold on to it until you reach your retirement age, and then you start transitioning into retirement. I digress. I apologize, but I digress.
No, I've got to share this because you've segued into something that I can just touch on really quickly. And this is one of my favorite charts. And my friends at Pro Solution created this one, and I'll always credit them. It's simple, but it's magic. It shows a $500,000 property that increased in value by 8% per annum over 15 years. Now, we can say what we want about the rate of growth. Some will say it's too lofty, and that's fine. This is all about demonstrating the power of time. It's not about arguing whether property delivers values like this or not. But let's say the property is delivering 8% year on year. We both know that property performance varies, but when you stand back and look at the big chart, you'll start to see a stronger line. Anyway, the first 5 years block, it delivers capital growth of 235,000. The second 5-year block, 345,000. And then the final 5 years is 507,000, because we're seeing the magic of I've just lost the word. Lacey, you're going to have to help me out here.
Compounding
growth. So the point is, you can look at this asset and say, after 5 years, ripper, I've got $235,000 gain. Or people who aren't familiar with property might say, oh, that suburb's done its thing, it hasn't got any more steam in it. I've heard that one a million times. People say to me, oh, I can't buy there because it's already gone. They don't go, they keep performing. They just might have a slightly different growth rate. Anyway, the point to your story is that if you held this for 15 years instead of 5, in your final 5 years, it delivers almost half of its total growth. So every single block that you give it to keep performing, you'll get continued capital growth. I think it's powerful.
And so I guess that moves us nicely into, if you're currently holding property and you're concerned about a property correction, a property crash, or interest rate rises, what do you do? I know some people are wondering whether or not they should sell their property. We've already touched on the fact that if you had purchased a property with the view to hold it long term to assist you in retirement, then the only thing you need to worry about is being able to hold the asset during periods of time with higher interest rates. I think we'll touch on the interest rates in just a minute. Cate, if you can lead off with that in just a second, and talk a little bit more about what we should expect from interest rates and that. And what I will say in wrapping up what to do for those people who currently hold property in Melbourne and are wondering whether or not they should get out. If it's a long-term investment, the only thing you need to be concerned about is actually holding the property through the lifetime that you are going to own it. And there are going to be periods of time where interest rates go up and interest rates go down. There are going to be time when we have softer rents and we have rents that are going up quite rapidly. And each of those two things do impact your holding costs. And so what I would recommend for anybody who currently holds assets in Melbourne or across Australia is to stress test your repayments. You need to sit down and look at what would happen if interest rates go up 2%, 3%, and work out at what point you could no longer hold that asset for. And once you know that figure, then you need to talk with your mortgage broker, potentially, hopefully it's a strategic mortgage broker who has experience with portfolio building, and talk to them about how you can offset your risks of the potential for interest rates to go up to a level that would be unsustainable for you. What I found in my experience of 20 years in real estate is that buyers who get their back up against the wall and sell because they have to are the ones that generally are selling at the wrong time and are the ones that are losing money. I always want people to be in a position where they're choosing when they sell their asset. And so for that to be the case, you need to have a buffer in place and you need to stress test your repayments. You need to know what's going to happen if rentals go up or down, as well as interest rates. And the last thing that I would say, and this is a big trap I think a lot of people fall into, is if you've been a rental provider for a very long period of time, I want you to ensure that you are always increasing your rental prices across your portfolio, unless you have chosen a property to specifically be a charity case. And I don't mean that in a negative way. I know that some investors do to provide social housing intentionally at a lower rate, and that's their way of giving back. But for those who are not choosing to do that, please ensure that you keep your your rentals increasing in line with the market conditions. I had a client recently who I did an assessment for. They've got 5 properties, including their own home, and they have not kept on top of their rental increases, and they're losing about $8,000 a year in rent, which was fine when they had the capacity to hold the assets quite comfortably. However, their personal circumstances has changed and money is a little bit tighter for them now than it was. And now all of a sudden we're in a situation where these tenants have been used to paying incredibly low rents, and they're going to really struggle to find a rental that is the same level of accommodation that they're currently used to. So you actually don't really do the tenants that much of a favor to keep rents down low, because they get a shock when they start shopping and realize what the price of rents are. And sometimes landlords of rental providers can have an issue moving the tenant on. And that's something that a family member of mine has just experienced as well.
Yeah, amazing insight. Now, I've got a chart that will help us segue into the relationship between our stock levels, our opportunity as rental providers to have, I guess, a business model that's running a little bit more smoothly than what they have in previous years. And in saying that, what I mean is we've tackled vacancies, a lot of us, and we've had rents that haven't moved very much in the last decade. And these days we've got a little bit of a different picture, and for some cities it's a little bit of a crisis in terms of not having enough houses to house people. But I think it's a really valuable chart to have a look at, and just to work through how our market outlook could shape up following this election. Now, Lisa, am I on the right chart?
You are. I think
okay,
we've
awesome.
got the all listings and the new listings. Is that what you were wanting to look at?
Yeah, it is. So the first at the top is new listing. So that's as a vendor decides to list their property, hits the market, it's a number. And the darkest line is a current year. That's 2022, shows where we're up to now. And you can see it's just come off its peak, but fair to say that by anyone's measure, our new listing activity is not underdone. Now, you and I often catch up when we're out there on the road and we complain about stock levels. Stock levels haven't been too bad of late though. And we had a lot of vendors flood the market for various reasons. Some were happy to be able to list their property and avoid issues with lockdowns, so they knew that they could have a consistent campaign. Other vendors had genuine changes that have been precipitated by COVID, whether it was finding a country house or upgrading the size of their house and moving. They had a property to sell. And for some sadder stories, we had some relationship breakdowns that, you know, really cracked under pressure with COVID. So we saw a lot of sales for lots of different reasons, and that selling activity has calmed down from what it was last year. And remarkable to think that we had so many listings last year, but we still had price growth, which means that we had an enormous number of buyers, really strong buyer appetite. Now, the second chart is the interesting one. This shows all listings, including properties that have been for sale, and they're, you know, at page 50 now. That we're talking about stock that's been on the market for more than 6 months, and for some they've been on the market for over a year. Now, the number of total listings is very low compared to last year's, and that indicates that a lot of these old listings that we didn't want have been snapped up. Now, the next chart tells a really interesting story, because this is rents, it's rental movement. And with the old stock being snapped up, we saw some rental providers getting really sick of the conditions or financially feeling so challenged by them. And I'm talking about vacant 1-bedroom apartments in Melbourne CBD when we had nobody who wanted to rent them. So we had a real issue for people who needed that rental income to make this work. And so either out of desperation or frustration, they put their rental stock into the buyer market. So they were selling their property instead of trying to rent it out. And we have had a lot of people snapping up these properties, whether they're first home buyers, whether they're people who have their country home and they've decided to get a little city pad. We've seen a lot of this stock selling to owner occupiers. The challenge that we've got is the rental pool has shrunk. We've got people returning to the city, and that's put pressure on our change in rents. And as you can see for the units here on the right, Melbourne is the red line. It shows one of the sharpest recoveries, and so does Sydney for the same reason. We've had a lot of people coming back to our cities, and we haven't got enough stock to meet the needs or meet the demands. And so we've had an increase in our rental prices. And at one stage we were down near -10. So it's a very dramatic recovery. And it's interesting to note that we've seen a lot of these properties go into the buyer pool and get sold to owner occ. So I think we've got potentially a looming crisis, but an opportunity for investors as well.
Yeah, I think that leads us into the rental increases in vacancy rates. So we've had some differing data points, and Cate and I have discussed the difference in data points this morning. We've had one data set saying 5% rental vacancy for Melbourne, which is certainly not my experience personally on the ground. And then we've had another data source say 1.8%, which to me feels more accurate across the board for properties. There are some areas that when we're doing rental analysis, we type in and there's literally 1 or 2 properties available for rent. And when we do put our investors' properties on the market for rent, we're finding that we're getting a lot of people inspecting the property, multiple applications, offers for paying 6 months in advance, and we're actually achieving greater than our highest estimate for a lot of the properties that we're purchasing for clients. Part of that is because we are buying A-grade property that we know renters really, really desire. They've got elements that are difficult to get for renters, and we're achieving 5% more than what we're actually asking for at the top of the range for rent. So I think there is a looming crisis on the horizon. It's actually quite concerning. And I'm seeing the stats are showing that rental prices are up roughly 10%. And I would say that that is probably pretty accurate from what I'm seeing as well on the ground.
Yeah, agreed. Same, ditto.
Okay, so Cate, everybody will be wondering what our thoughts are on where the market's going from here. Shall we wrap up by each sharing what our thoughts are, and would you like to kick us off?
I'd love to. once this election has been and gone, I'll be pleased not to see all of the ads, but I'll also be pleased to know which incentives are going to be applied, because we've got two parties, the Coalition and Labor Party, suggesting that they're going to provide some really exciting incentives and initiatives for first home buyers and for other market entrants, not just first home buyers. My prediction is that we're going to have a little bit of a two-speed market when that happens. I think we'll get some dramatic uptake, and I think that the sub-$1 million market could really surprise us. And I also feel that once the election's behind us and people can get on with things and know that we've at least got that certainty for the next 3 years, we'll see some buyer nerves calm down a little bit, and we'll see people return. What we do know is stock levels aren't about to take off again, and we're approaching winter. So we might find that the supply demand imbalance favours some market upwards movement. And lastly, I've filled my head with too many bits. I had one important thing to suggest. I think that investors will continue to stay very active in the market, and that will place some pressure on price growth as well. Investors are active because we have credit availability, and also our returns are looking pretty good. We've got gross rental yields looking up for the first time in a long time, and that doesn't look like it's about to slow down. And lastly, the regions. I think that regions that are within a 2-hour commute, and particularly within a 90-minute commute, will continue to thrive, because COVID didn't just bring people out of the city and into the regions. Housing affordability and opportunity did. And now that we can work remotely, I don't see that trend disappearing.
Well, I'm nodding because I'm in agreement with everything that you've said, Cate. So, which is not surprising. I mean, we're both working on the ground, and we've both been doing this for a very long time. So, I tend to agree with you, Cate. I think I'm actually excited to see what happens after the election. I know that the last federal election, the phones and the inquiries started on the Sunday. Do you remember? Yes. They didn't even wait till Monday. The phones and the inquiries coming through the website had started on the Sunday after.
Sunday.
Yeah, it was crazy. So I'm curious to see how quickly buyers start reactivating their searches again after the election. So that's one thing that I'm looking forward to, but I'm gearing up for a very, very busy September to December quarter. I mean, that's where we always have the most stock. It's where we always have the most buyers active in the market. But I'm gearing up for a very busy end of year. I don't see a crash on the horizon. I don't see anything catastrophic with the Melbourne property market. I see that there will be, as you said, a two-speed market, but I'm going to look at it from a slightly different angle. And I agree with what you said, and I'm going to add something to what you've said. The two-speed market that I am going to comment on is the property, the quality of the property. What we're already seeing is that properties that aren't presented well and that have been left go, either because they've been tenanted for a really long time, there's a lot of repairs, they're the properties that are suffering when it comes to auction day, and they're the ones that we're seeing price corrections, and we're seeing less buyers interested in those types of properties. And we're seeing, we're seeing the 4 or 5 buyers on the very, very good quality A grade property. And we're seeing that type of property be snapped up quite quickly for prices that are comparable to last year. But with the B grade properties, I think we're already discounting it quite significantly, probably about 10%. I think within our office would be the average that when we're assessing properties, because we're accounting for all of the maintenance that needs to be done. Of course, we've got rising trades and building costs. And so renovation costs have gone up considerably, and we need to factor these elements into our assessments when we're working for our clients. So I think we will continue to see properties that aren't presented well and have a lot of maintenance, and B grade properties, I think they will struggle and they will come back 5 or 10%. But I'm seeing good quality property continue to, just have minor growth, maybe negative positive month on month. I don't see any crashes on the horizon.
Well, there we have it. I've really loved doing this, and we've got so many fantastic charts and observations. We could have talked for 5 hours. But what I'd love to do is promise the audience that we'll come back post-election and speak honestly and openly about what's happening on the ground.
Thanks everybody for tuning in, and we look forward to giving you an update in about 6 weeks' time.